This is Gabe Wilcox from ScaleView Partners, the investment bank for founders by founders. Speaking today with Aaron Perman from S3 Ventures. Aaron, how are you?
I'm doing well.
Awesome. Thanks for coming on today. To kick off, why don't you tell us a little bit about S3, what you guys do and what you focus on at the firm?
Yeah, happy to. So S3 Ventures, we are the largest venture firm in Texas focused on Texas-based companies. And so we're primarily investing in Texas-based founders and then opportunistically in middle of the country based companies as well. And typically investing at the seed, Series A, and Series B stages. So generally investing in companies that are doing anywhere from a few $100,000 a year of revenue up to $3 to $5 million a year of revenue, depending on the stage. We have $900 million under management. Firm's been around 17 years. We're investing out of our seventh fund. It's a $250 million fund that we raised in 22. And a little bit unique about us, we only have a single limited partner. And so that's a unique aspect of our firm relative to a lot of other venture firms. And that's beneficial for founders because we can have a lot more patience. We don't have the difficulties around having to sell companies earlier, have these kind of weird pressures around fundraising. And it allows us to spend all of our time with our founders. So we don't disappear every 18 months to go fundraise either. Really focused on business to business technology. That's the vast majority, whether it's software, marketplaces, infrastructure. And then we do some consumer digital experiences and medical device investments as well. I'm a partner of the firm, been with S3 for the last decade. And then prior to this was at a long short equity fund, investing in public companies, some operational experiences before that, and then spent about a year as CEO of a SaaS business, leading it through to an exit. So that's a little bit about me and the firm.
Awesome, thanks. So you're likewise in Austin, where we're located. What's it like being, a large venture firm kind of outside the coasts? You mentioned that you focus a lot on Texas-based founders and other founders across the middle of the country. Do you feel like that's still an overlooked and underserved market?
It's interesting. Yeah, I wouldn't say overlooked and underserved anymore. I think it's just a great market to build a business. I think some of our focus, is, I think, to your point, that the ratio of engineers or GDP to venture capital dollars just has historically been out of whack in Texas, in the middle of the country, and relative to California and other places, and I think still is. But I think the bigger reason is that you have lots of talent flocking to Texas and to Austin. Your cost to build a business here are still lower than the coast, so that the capital you raise goes further. And then somewhat selfishly, like, we can be more helpful to local companies. We have a full-time director of talent to help our companies hire executives, and her network is here. Our networks are here for hiring. And we like to, roll up our sleeves and spend time with our companies. And it's just a higher return on time to be able to do a Southwest day trip, or drive down the street and whiteboard stuff out than, try to do that, thousands of miles away.
Awesome. No, it makes a lot of sense. The value prop of an investor who's able to be pretty hands-on and be pretty involved is really high. So I think that's pretty compelling for your companies too. Let's back up a step and think about sort of the founder's perspective. It's a question that we hear a lot, that we thought about ourselves when we were running a software company too. Is when is the right time to raise money for a business? We'll start there.
I always say, before you need it, but sometime between before you need it and when you need it. And so I would think about it as when is the right time to raise money from certain people. And so what I mean by that is, I think there are different stages, and I think if you're barking up the right tree at the right stage, you're most likely to be successful and have the most efficient fundraising process as possible, which is usually a good thing, because you want to spend as little time as possible fundraising, as much time as possible building your business. Fundraising is kind of more of a necessary evil. And so what I would kind of think about is that, early stage. So if you are, pre-product or early MVP, don't have material revenue yet, at that stage, really the trees to bark up are, for some of us, there are friends and family that can write $25,000 checks and to go raise, $500,000, through that grind. Some of us don't have friends and family, but that can write those checks. But there are maybe other people in your network, like mentors or former colleagues, or people that could be advisors and actually open doors to you and to customers. Another thing, large enterprises, if you're a B2B software company, and those can be great other places to raise money alongside accelerators, incubators, pre-seed funds. And so usually at that stage, those are the kind of the capital sources, right? And so, when you start to see firms or see companies that are raising that first kind of $2 to $3 million institutional VC check, a lot of times that's when you have a product and a handful of initial customers, maybe 20, 30, 40,000 a month in revenue. If you're B2B, if you're B2C, it might be more user-based. And that's really when you start to see, there are some firms that define themselves as pre-seed firms, but the firms that are really like post-revenue seed and up, that's when they start to be more common to invest, make investments. And so I always think like it's worth starting relationships 12 months ahead of when the firm's necessarily the right fit, but just being cognizant of how much time you spend building a relationship or focusing on your business. And so I think when you think you're 12 months ahead of that, definitely worth getting more intros to firms and maybe doing 30-minute intro calls. But I wouldn't necessarily try to raise from certain types of firms till you're the right fit for them, because you can just burn a lot of cycles and they'll take meetings and you won't necessarily end up, closing on money.
Yep. Got it. That's helpful. Yeah, it's always, you got to remember, it's the job of somebody over on the investor side to take the meetings, and it's your main job is to run the company and grow the company, though, right? So you always have to keep your eye on that.
Yeah.
Okay, let's maybe fast forward a little bit into the deal process. Let's say you've got a company where they're at the right stage and they're having conversations with the right firms to raise some capital. The next step, there eventually would be, maybe you get a term sheet, you see an offer from one or more firms. That's a moment where I think, again, a lot of founders, might be their first time seeing that. They don't necessarily have experience there. What are some of the key terms that, how does the term sheet work? I guess to back it up, what are some of the key terms that are worth focusing on there? And maybe a little bit on the market today. What are some of the kinds of things that founders are likely to see in a term sheet?
Yeah, that's a great question, because markets are changing a little bit than they were a year or two ago. I would back up and say, so there's a group called the National Venture Capital Association. Their website is nvca.org, and they have like a model term sheet document and model financing docs. And most kind of down the fairway venture investors, right? Like they make their money on the company being successful and everyone having, a piece of a really, really big pie. They're generally not making their money on coming in and being heavy-handed and structuring things and things like that, right? And so like, if you look at like our term sheet, for example, it's very close to the model NVCA term sheet on their website. And so I think 90+% of term sheets out there are within a half a standard deviation. Every venture firm might have their little tweak here or there, of that term sheet. And so like in my mind, like that's a good place to start. I think having an experienced attorney where all they do is tech, venture-backed tech companies, and they live and breathe this stuff, they can very quickly tell you what's in market, what's out of market, what should be negotiated, what shouldn't be negotiated. Because I think the most brain damaging thing for someone on my end of the table and for everybody is when you're trying to invest in a company, they're great, and like they have a friend of a friend that does like leveraged buyouts or family law that they're trying to use. And it's like and what ends up happening is they negotiate the things that like are boilerplate that they shouldn't even pay attention to. And the stuff they should be paying attention to gets ignored. And it just makes it really painful and difficult. So don't try to kind of reinvent the wheel here. But I think in terms of like, specific terms, assuming you have a venture firm that is using the standard docs, the things you typically see and pay attention to, are things like, valuation, the share price that they're investing at, right? And how much ownership the firm's going to end up getting, the board. And so board structure, how many board seats, who has the right to appoint which board seats, the type of security. So, there's, generally venture firms invest what's called a preferred security, which gives them ownership as if they had common on the upside, but gives them protection for their dollars, almost like debt-like protection on the downside, where if the company doesn't sell for much money, they kind of get their money back off the top. And there is something called claim preferred and participating preferred that, a lawyer can walk you through, and that's kind of important. I think where sometimes you'll see founders kind of stumble here is when they're looking for a really, really high valuation, so like the highest share price, but then the term sheet has other things that are out of market in it around, maybe the investor gets 2 or 3 times their money back before the rest of the investors get anything. And so I always advise companies that like a clean deal is the best deal. And so, just especially in the current market, again, that's not something we generally do, but just those are things that I would kind of pay attention to. And then the other thing is like, there will be things like exclusivity time. So how long you've agreed to exclusively negotiate with that firm to go close the deal. And really anything over 45 days in my mind is a red flag. Like, as a firm, just from an ethos standpoint, in my decade at S3, I think we funded every term sheet we've signed, and we do all of the work up front. And we think it's irresponsible and not the right thing to do by founders to lock them into exclusivity while they're generally still burning money and they're raising money because they don't have tons of it. And then do our work. And so we do almost all of our work up front, and everything else is legal docs and confirmatory. And if you see a venture firm that has more than 45 days to close a deal, has 60, 90, 120, that should be a red flag. They're just trying to lock you down, and then they're going to do their work. And so that's something that, I would really pay attention to. So those are kind of a few things to look at.
Okay. Yeah, those are really good points. I want to come back to the sort of due diligence piece of it when you do your work to figure out what's, the company and whether it's the right fit for you. You did mention valuation, and really important point that valuations aren't apples to apples unless structure is consistent between the two. So that's a really important thing to look at. But you've invested in a lot of SaaS companies. Let's talk about SaaS valuation in particular. What are some of the, all companies aren't created equal. I won't ask you to just kind of say what's a SaaS company worth, but I think what would be helpful for founders is, how do you think about what's my company worth? In other words, what are some of the metrics that you as an investor are going to look at to say, this is a really high quality, this revenue is of high quality. We want to pay a higher multiple for this. What are some of the things, beneath just the revenue number that you want to see to sort of put that value on the company?
Yeah, so I would say, like, real simply, right? And this is again a misnomer, but like, a lot of times people look at your revenue and put a multiple on it. Maybe it's, 8, 10, 12, 15 order of magnitude, something like that, right? And that really starts to happen when you're kind of a million or two of revenue annually and up. Usually it's kind of on the annual recurring revenue. Under that, it's a little more kind of market driven. And I think the rough rule of thumbs is like, for every round of venture capital you raise, usually you're selling somewhere between 10 and 25% of the company. And so in a lot of ways, it's almost like the round size is this to get to this far, kind of all back solves in a weird way to be remarkably kind of consistent. But I think in terms of what drives higher valuations, right, and higher multiples, there's a few things, right? I think at the earlier stages, one really important thing is like, do all your customers look the same? Are you truly a scalable product company that has, a big market, right? And within that big market, you've sold to 5, 10, 15, 20 companies that all are repeatable, similar use case, and you've kind of found a nail on a hammer you can just kind of keep hammering away at. Have you retained them, right? So do your customers retain and hopefully not just retain, but do they hopefully grow over time as you give them more value, build more product functionality? And that kind of leads to what's called net revenue retention, which is a metric. And I think, top tier companies are 120 or 130% a year and up, where existing customers are growing 20 to 30% every year on top of, new customers, and then just kind of growth rate in general. And really, like, VCs are typically looking for companies that are, growing 70 to 100% or more every year. So kind of almost or more than doubling every year. And then I'd say the last thing that people are really paying attention to kind of burn multiples, right? And so how fast are you burning relative to your growth? There's burn multiples, rule of 40s. It kind of all yields the same result where like, if you're growing really, really, really fast, you can burn more, but like, you don't want to burn like unlimited amounts. And there's a relationship between the two. Candidly got a little bit untethered, I think, when firms were looking at companies a couple of years ago that now they're really looking at. And so it's the efficiency of your growth is real important. And I'd say the last thing is kind of like sometimes deep technical moats. And so like companies that, are workflow software can be very valuable, right? But like they may be valued differently than something that's a system of record where customers are storing lots of data, or things that have like deep, hard technical innovations that maybe took years of PhDs and a lot more capital to kind of build out the product than a lot of other companies. And so those sometimes might get valuations that are a little less tethered to revenue, but when they get product market fit, they can grow really fast without a lot of competition.
Interesting. Yeah. Okay. So deep tech there. The use
And
case.
That's a lot of the AI stuff right now.
Yeah, sure.
Yeah.
Makes sense. The use case one is pretty interesting to me. So for a relatively early stage company, it actually can be a little bit of a red flag if you see across their customer base that they're kind of using it in different ways, or the customers don't look all that much like one another, which is a little bit counterintuitive because like, oh, we have all different kinds of companies who like our product, that feels like a good thing. But what you really like to see is a set of companies that look similar. And then you want to look out into the world and say, oh, there are a lot more companies like that we can go knock off, right?
I think that's like at a high level, yeah. And I think, like if you're a horizontal platform, like a, database or a piece of DevOps infrastructure, I'm not saying like they need to all be the same type of company, but like ideally they're using it for a similar use case, like to store a certain type of information or otherwise, right? And so it's really like, is there repeatability to the sales cycle? And I think to your point on the flag, if they're customers that are all using like things in different ways, a lot of times that might mean there's really 10 different products that have all been customized, and it's more of a services business versus a product business, which like can still be a great company, but it doesn't typically fit the venture model of build a product that can be sold scalably to a whole bunch of customers.
Yeah, that's a really good insight. Let's talk now about come back to sort of the comment you made before about doing your work. In other words, due diligence. So between sort of first stages of meeting the company and some interest in a term sheet to actually getting a closed deal, what at your stage of the market, what does that look like? And you mentioned you guys try to do your work up front so that when you issue a term sheet, you do intend to close on it. But what are some of the things that founders should expect to have to produce, to have to go through for a process like that to get a closed deal?
Yeah, that's a great question. And I would say, like, again, our stage is companies that have anywhere from a few $100,000 of revenue annually up to, $1 million or $2 million, up to $3 to $5 million. That's when we're doing our initial investments. And then typically we'll do multiple follow-on rounds after that. But at that kind of those stages, I would say a few things. Like, first off, we try to use founders' time as efficiently as possible because we realize that's their most valuable asset. And so we always try to move through kind of with purpose and a plan. We may meet with a company, for 30-minute catch-ups or whatever for a year or 2 years before we're really engaged. But so kind of, and we'll try to be helpful and introduce them to customers or talent kind of over that time so they can get to know us a little bit. But you kind of fast forward to when it's to your point, like, hey, we're engaged, this is a good fit, the right stage, fundraising has started. Usually we can get from that to at least, hey, we're interested, here's a summary of terms, let us know if we're in the ballpark, we'll put it in the full term sheet in anywhere from 3 to 6 weeks. And kind of through that process, it might be an initial meeting with, me or one of the partners that's leading the deal and an associate that's going to work on it. And then maybe like a follow-up. And then pretty quickly, in that time, we'll start doing some of our own market research and diligence. And usually though, for that first meeting, it's good to have a kind of a 12 to 14 slide deck. that walks through, who you are, what you do, what problem you're solving, how big the market is, kind of early customers, how they're using it, and then your financial plan. We'll typically look for things like, a financial plan as well. And it's not that it has to be super complicated, but we just want to get a sense of, how's revenue grown historically? How much money have you been burning? And then want to be able to work on together, like how much money do you need to get to that next stage, right? And usually that's a 24-month time period to then raise the next financing round once you've hit an inflection point. We'll look at things like your sales pipeline. We'll want to look at product demo, roadmap, dig into the technology with your technical leaders, those sorts of things. And so kind of think, a few hours of kind of meetings and things like that. We'll be doing research on our end. Late in our process, we might do a 3 to 6 hour session with our whole partnership, digging into all aspects of the business. And then at some point, we will try to introduce you to a few customer prospects, typically if you're a B2B software company, and be able to listen on all the conversations, get feedback from people that know a lot more about your end customer persona than we do. And so hopefully, worst case, if you spend time with us, you get a customer or two out of it, even if we don't invest. And best case, you get an investment and a customer or two out of it. And that allows us to get kind of industry feedback without us pre-term sheet having to talk to your customers, because we realize those relationships are super valuable. And so think that can kind of be a process done over 3 to, at most 6 weeks. And at that point, usually what we'll do is we'll, say, look, we do standard MVCA deals. To our point earlier, here's like the 5 key terms. Is this in the ballpark before we spend money on lawyers and we make you spend money on lawyers? And when we get kind of a thumbs up within a few days, we'll whip up a full term sheet, hopefully get that signed. And then once that term sheet's signed, we're basically in unless, confirmatory work shows something wasn't true, which has fortunately never really happened to us. And so usually once we've signed that term sheet, we'll have a deal closed within 30 days if possible, 45 at the latest. And it's lawyers taking the term sheet and drafting them into formal docs. And then we'll usually, on a confirmatory basis, want to talk to a few of the biggest customers just to have them kind of trust but verify what we, have heard from the company. And those have, pretty much always gone well. And then we're investing. So that and I think for founders, like, when you're going to be doing this dance with us, you're probably doing it with 5 of the firms or more at the same time. And so like, to the extent that you prepare before this, it makes it way easier, because it's hard enough to run the business and manage these conversations and produce things for ad hoc diligence requests. And so prior to even starting fundraising, like get your 14 slides down, get your story down. That's a lot easier if you already have good marketing and product marketing and messaging. And if you don't, that's an area that companies frequently underinvest in. So I would look at investing in that ahead of time. Get your financial plan down. Again, it doesn't have to be complicated. Investors just want to see a monthly plan of like who you're going to hire and how much that will cost to know how much money you actually need in this financing round, and get things like your sales pipeline exports, your product roadmap slide, things like that. Just get it all tidy before you start the heat of the conversations, so that you can kind of phase the workload out a little bit and not sort of be building the plane while you're flying it, while you're building the other plane, which is your company, the more important one, while you're flying that one.
That's really helpful. I think a lot of founders have, there's sort of a mystery around if I did go down this path, what would it mean? Even how would it, work, and what would be required to get it done? And so I think that really helps demystify it at your stage. I think, in our experience, that basic roadmap you laid out remains true of investments, even up to a later stage. A growth equity type deal doesn't look all that different from what you described either. We will come back to kind of selling the company. I know that you've been a part of some successful exits as an investor too. So we'll come back around to that, what it looks like in a bigger M&A type context as well. But that's really helpful. I think the other one that I wanted to
actually, the one of the real important thing I'd say is to go through that process is to treat it as a collaborative process. Because ultimately, like a large chunk of what we're doing during that is figuring out what it's going to be like to work together, and are we going to work well together. And so I'd say that's just don't overly sell it. Treat those sessions as an opportunity for you to try working with the investor and your board member potentially for the next decade, and make sure that y'all will have a good relationship, because that's picking an investor is kind of like getting married with no divorce.
Yep.
So make sure that you use that as an opportunity to try out working with them.
That's a great comment. I'm glad you said that. It's like a lot of things in life, whether it's marriage or like finding a job that fits for you. There's maybe an intuition that you want to sell really hard and make it work, but in reality, you sort of need to think of it as a matchmaking exercise where you want to represent the company pretty accurately, so the investor is all in. And you want to make sure that it's the investor that you want to spend a lot of time with. That's a really good comment. That kind of brings me to the next one I wanted to ask, which is like, besides what is it like to get how do I get a term sheet? How are they going to value the company? How will they due diligence and close the investment? The other big question I think founders often have is like, well, what is life like then? If I go and raise money and I have, Aaron now is on my board, and I have a VC on board. What does that even mean? How is life different? What's better? What's worse? Talk a little bit about how you work with companies on an ongoing basis, and some of the good, some of the bad, ways that it can get sideways, not necessarily with your businesses, but things you've seen before. How should founders think about life after investment?
Yeah, I mean, I think, once we're invested in a company, our goals with them are aligned to maximize the value of the company. And so we're kind of all in on doing whatever we can to help do that. And, usually that's them pinging us, but also us, like, we're looking at things like what customers can we introduce them to? We just brought on a full-time director of talent to help them with sourcing execs as they build up their exec team. And all this is free to our companies. We don't charge for any of it. We have a whole team of associates and VPs that can, work supervised by a partner, like work with the companies to help do work for them, whether it's building out a financial plan or looking at, potential acquisitions or helping on a go-to-market project. And so, we kind of see our job as doing whatever we can to help make them successful. And it's funny, I have, Slack on, and I'm seeing Slacks. I'm on Slacks with half the founders I work with, and I've had multiple Slack messages from them during this session, pinging me with questions or things, we could potentially do to help them. And so, I would say, like, we don't look at it as an overly kind of formal relationship, but we talk to them once a quarter or every other month at a board meeting, and that's it. We kind of look at it as a partnership where a lot of times they're pinging us, depending on the stage of the company, whether it's, every other week or once a month, saying, like last week I had a company say, hey, we're working on a new sales comp plan. You've seen a bunch of these. How can you, can you help put this together for us or with us? I do think that, like, to your point, where can things go off the rails? And I think it's important to remember that, your investor is in this with you, and the good, the bad, the ugly, they just want to be able to help. Yeah. And so as long as good news travels as fast as bad news is okay. It happens. Like, every startup goes through bumps in the road. And the worst thing you can do is try to hide the bad news, because then that just breaks down trust. The best thing to do is plenty of our most successful companies, when something bad happens, they lose a big customer, employee issue, something like that, website goes down, his service goes down, I'm usually they're calling and texting and saying, hey, this happened. How can we figure this out together? And it's, that's just part of being invested in early stage companies. I do think the one area, once you kind of have, your first board member investors, there's a little more tightness around just like doing financial closes and having financials and, board deck, but that investor is there to help you put that together too. And even though it may not seem like a good use of time, you kind of can't measure what you can't manage, what you can't measure. And so it may seem like a little bit of overhead, but they're there to help you minimize the overhead, and I think it will make you better long term. But we really try to be cognizant at being stage appropriate for that type of reporting, because we have LPs we have to be able to report to as well. And so we do try really hard to be stage appropriate and not take unnecessary amounts of time on reporting at the earlier stages.
Yep. It makes a lot of sense. I mean, my experience, I know with my software company is that there's some stuff that feels like overhead, but it's actually part of the benefit that you get from, you know, getting an investor on board is you get to grow up a little bit as a company, and that sometimes it has a little bit of pain, temporary, you know, that goes with it. But you know, I think having that a little bit of formality that, you know, you probably don't have as a bootstrap business is a good thing for the company, particularly when it comes time to sell the business, which is what I wanted to go to next. You know, obviously at ScaleView, we work on M&A advisory when companies are ready to sell to a strategic or a private equity group. You've been part of that kind of exit with some of your portfolio companies. How, you know, my first question really for founders is how do exits happen, right? How have you seen it happen in the past with some of your companies who had really great outcomes? And then, you know, maybe you can talk a little bit more about how that process goes. You know, things like having discipline around financial reporting and things like that really, I know, pay off when it comes time to get involved in a bigger deal like an exit. But tell me a little more about some of your experiences and how they came about and how they went.
Yeah, that's a great question. I would say there's like a couple of types of things that lead to exits, right? There's, you know, one type of thing, which is, you know, the company's got into a good point. The, you know, founder says, hey, I think I want to sell. The investor's okay, this is a good time, it's a good market. They hire an investment bank, run a process, kind of, and like that. And we've had good outcomes from that. I would say like a large chunk of those don't actually end up don't always transact. But we've had some that have transacted and have gotten really, really, really good returns, right? So I think, you know, one misnomer is sometimes companies, you know, they say, hey, good companies only get bought, they don't get sold. And there's a twinge of truth to that, where like, yeah, it's great if someone shows up, but look, if it's the right time for you, right time for your investors, you know, you can sometimes hire a bank, run a process, especially if you've had people that you've kind of had relationships with over the years, and using the bank to kind of formalize and run that process and get really, really good outcomes. And we've had that happen. You know, I think the other key way exits will happen is sometimes industries go through like consolidation cycles, right? Where, you know, a competitor bought something, so then they feel like they need to fill that hole in their strategic roadmap. Big companies do. And these are for M&A exits. We can talk about IPOs if that makes sense, but this is kind of M&A exits. Yep. And, you know, ideally as a company, you know, the founder and CEO is spending time talking with potential strategic partners kind of for years, where they're just, you know, building relationships. You know, maybe they're a channel partner where they could be co-sell or resell some of the founder's company's products. Maybe they're just straight up competitors, and it's still worth talking to them, right? Mm-hmm. And, you know, one of them maybe gets wind that you're raising your next financing round, which would set an even higher bar for them to buy it in the future, or otherwise, you know, or they decide it's the right time, or if some market thing happens, and they show up and make an offer they think you can't refuse. And then there's a decision point of what do you do, right? And, you know, some of the best outcomes I've seen have come from, you know, saying, that's not really interesting. And then sometimes they come back and double it. Right. And then you really got it. And sometimes this dance happens over, you know, a 1 month period, sometimes over a 6 month period, sometimes over a 12-month period. So this is an 18-month dance. Mm-hmm. And maybe then you say yes, maybe you say no again, and they come back and double it a third time. And then it's like, all right. You know, and you know, as that goes, you can then start to get other potential, you know, parties interested. And sometimes you know, you've done this before, you have a really experienced board, you can successfully run this yourself. Sometimes, you know, you'll still get a really high value add for bringing on a bank or an advisor that can kind of be that arm's length party that can have the tough conversations with, you know, maybe your future boss, you know, to really drive the price up. But, you know, I think a lot of times when someone kind of comes in, you get inbound interest, that can drive some of your best outcomes. But you know, also realize you can accidentally leave a lot of money on the table on those, where a lot of times the first offer is substantially below what they're willing to go to if you're able to, you know, effectively negotiate it.
That's interesting. we pretty strongly believe at ScaleView that you can't, no banker is likely to sort of dress up a company that's not good to get some kind of great outcome. It's just most buyers are savvy enough to figure that out. But we do believe that good companies get great exits when they run a pretty structured process to get there, right? And so I think if you're a good company, you're pretty likely to have interest all over the place, probably from competitors and partners and growth equity investors and other private equity shops. I mean, those are all groups that are looking for great companies to invest in. But we strongly feel that it's you get the very best outcome if you're able to, as you said, put some structure around it, create some competition around it, create some urgency, even like you said, to get that offer from okay, maybe double again. You've got to kind of give them a reason to do that, right? And if you just go right down the path, then that reason's not there. The hard conversations one is also pretty interesting. It can be pretty tough to sort of talk about how excited you are about the deal and the merger of companies, and at the same time, negotiate really hard and push hard on different terms. That's something that can be pretty tough for founders to manage as well. What is your, what role have you played as the investor and board member there in helping the founders, think through it and eventually get it done?
Yeah, it totally varies, right? And sometimes it varies on the experience of the team. Like, do they have a CFO that's been through a few of these before or not? I've done everything from be a very active board member, serving as kind of the negotiator, especially when there's not a bank involved sometimes. And then, our team can do some of that work around like putting together, the kind of the funds flow and the waterfall, helping on disclosure schedules, working on management presentations and decks to use in the sales process. I think fundraising is bad. Input up 10x in terms of materials during a sale, helping to, fill the data room. And these data rooms have thousands of documents, which by the way, start with the end in mind. When you sell a company, the buyer will go back from inception. Their law firm will pick apart every single board minute, every single employee, make sure there is an agreement assigning the company IP. And there are certain buyers that will not close if you had one engineer 6 years ago who you cannot find the employer proprietary information agreement. And you literally have to go track them down and beg them to re-sign it if you want bags. That's an aside, but
probably more than beg them, probably more like pay them.
Yeah, but potentially. We'll do some of that. We'll sometimes help the team manage the process so they can focus on the business, and because you have to also close your numbers during an exit. Like, you got to hit your sales targets, to maintain your price a lot of the time. And so, a lot of times we'll help work with the banker, the law firm, as they work through, the legal agreements and negotiations and working capital negotiations and other things, so that the team can focus on, the business as well. And so it really just kind of depends on what they need.
Got it. No, that's really helpful. And that's the kind of ongoing performance of the business is another thing that can be really tough on, particularly on a bootstrap founder who doesn't have a VC on board. It's kind of running the sale process while still making sure the business hits numbers. I mean, that's the most important thing to getting a closed deal right, is continued strong performance of the business.
Yeah, and like I said, we're all on the same team here, and so nothing is above or below us. Like, hey, I've stayed up all night sending out DocuSign packages with signatures and chasing down, the smallest investors to get to the threshold for deals to close. And so we're all hands on deck. However we can help is kind of our typical motto in an exit.
Yeah, awesome. No, that's really good stuff, Aaron. Thanks. It's informative, and congrats on having, like I said, been a part of some really nice exits so far. The last thing, we'll come back around to Austin. You're here. We're big Austin fans. What's your kind of commercial for for founders to come and start their companies in Austin or open up that next office here? What are some of the things that you think the city brings?
Yeah, I kind of look at it like building what we have in Austin takes generations and decades, because you don't have a talent pool like Austin's until you've had people come here, start businesses, have big multi-hundred-million-dollar M&A exits or billion-dollar type IPO exits, and then those people leave, and they now you have 50 or 100 people that know how to scale fast at the early stages and have the resources to go invest, and they do it again. And so Austin has a history of that from the 80s, when like the big semiconductors brought people here that left to start enterprise software companies. In the 90s, when IBM brought people here that left to go start enterprise software companies. And the 2000s, when Austin Ventures invested in a bunch of consumer companies. And so we have this just great talent pool, and then COVID happened. And all these great founders and startup people moved here from the Bay Area, moved here from New York, and probably accelerated the growth of that by 50%. And so Austin's unique in that I think it's one of the few cities outside of the Bay Area in the US that not only has a whole bunch of local capital and has, is a great place to build a business, better quality of living, things like that, but has the people to build the business. And that's something that I think you can't kind of just replicate overnight. And really makes Austin special for building, high growth tech companies.
Awesome. We're couldn't agree more. We're thrilled to be here. The ecosystem's incredible, and it's just going faster all the time. I think it's only accelerating. So it's an exciting place to be. Aaron, thank you. Aaron Perman, S3 Ventures. Thank you again for the chat today. Really enjoyed it.